Welcome to the Zacks Quarterly Market Strategy Conference Call, a service of Zacks Professional Services Division. For any time attendees, this is a live conference call that features Zacks strategists providing their analysis of the latest issues and trends affecting investors, the market and the economy, both globally and here in the U.S. This is going to be an informative, packed session. Zacks Chief Equity Strategist and Economist, John Blank, and Zacks Research Director, Sheraz Mian, will be our panelists today. John will give us the current economic story, complete with economic and market uncertainties that he sees and his thoughts on the trade war, the inverted yield curve we've been hearing so much about. Then Sheraz will give us a quick recap of Q2 earnings session that's wrapping up, and then take a more detailed look at the earnings story for the second half of the year. John, we'll start with you.
Thanks, Adam, for doing that. It was excellent. Well, let's please go to my first slide, which is just nothing more than unemployment claims. This is the basic point I think everyone needs to keep in mind, which is we are at a historic low in unemployment claims. And this is the essence of a very strong economy. So any headwinds we're going to talk about today, any headwinds, earnings headwinds, tariff headwinds, yield inversions, are coming up against a very strong tailwind, which is that unemployment is incredibly low. Now, the other thing to point out, looking back all the way to the 70s, is it was 2 years of sideways motion before there was a sudden spike up in unemployment claims. So, and it's also very obvious to you and me that these things spike. So there's an uncertainty here that's actually hanging around the edge of this data, which is this can spike. But the point is, on unemployment claims, they're a weekly number, not a monthly number. And so if we get a weekly unemployment claims number that moves up, and I'm talking move up 150 to 200,000, then you know to get bearish about the market. It's a really big number, it's a weekly number, and that's what you need to look for. Right now, it's very bullish. Let's go to the next slide. Okay, the other thing I want to get into today is language. I saw Jeff Gundlach the other day saying this expansion is 10 years old. It's very old in the tooth. Jeff Gundlach, of all people, which is probably the best bond fund manager out there. That's actually an erroneous statement. I'm a macroeconomist by training. And what you're going to notice here is the level of GDP for the United States. The gray areas are the recession areas. Now, what you should notice is that there's a huge, notable drop in 2007 associated with this last recession. Obviously, the gray area is bigger and the dip is lower. And those are related ideas. So the first point is recovery is a language that's used until you pass the previous high. An economy is in a recovery. After you pass the previous high, you're in an expansion. Now, just to give you an example of why that's different is, in truth, Gundlach's wrong by a factor of 50%. The expansion is only 5 years old. And that, again, is a very bullish statement, because you say, well, hold it, if we've only gotten past the previous level of expansion 5 years ago, that's not that old. And that's my point. Using the language properly leaves you with a 5-year long recovery, very, very long looking back on history, probably 2 or 3 years longer because primarily of the European debt crisis in 2012 and 13 that extended it. And that stalled the expansion from happening right away. And now we're only in a 5-year-old expansion, which is not as long as people think. So let's go to the next slide. Okay, industrial production. This is another one of these sleeper slides. Again, you see that big drop off the unemployment recessions of previous times, but also notice the 2016 period. That was the earnings recession. And there is no question that business capex rolled over in 2014 and it went down for 3 years. And there's no question, like 6 or 8 months ago, due to the trade war, it rolled over again. So this is a very different idea. This is U.S. industrial production, which is not a very big part of the U.S. economy. It's probably 10 or 15% of the U.S. economy. It's also sensitive to business decision makers, not consumers. And so here is a first example of something that's sub the economy that's affecting it, which is that people are holding off on doing CapEx in this environment. And we've seen that this can go on probably for another year, year and a half. Let's go to the next slide. Now the 10-year, again, looking back just over our history, you think, oh, they were really low rates. It's extremely dangerous yield curve inversion. We're going to go over the cliff. Well, the answer was we were at 1.7, 1.6 for a year and a half in this business cycle. And that was back in that period when industrial production was climbing. So the more likely answer here is the bottoming process for the 10-year is going to keep the yield curve either very slightly inverted or uninverted or flat for a year, year and a half. And that is not untypical of a situation where there's some type of event in the economy, but it's not toppling the entire economy. Now, we can obviously get quickly into toppling the economy. You got to put that factor 30%, but 30% is not 50%. It means 70% of the time, this thing is just going to stagger around for the next year, which is basically my point right now. I think you're looking at earnings recession. Sheraz will get a little bit more into that, but I don't see an actual recession right now. Obviously, these are quarterly calls. A quarter from now, I can certainly change my tune based on more data, but the data is not supporting it. Let's go.
Hey, I'm here.
Terry, thanks for coming. I'll let you handle Sheraz's questions. I'm about halfway through mine.
Okay.
What I've got here up is the housing number. Now, again, this gets to my basic idea of recovery versus expansion. If you notice, the expansion recovery somewhere in 14, from into the early part, there really was a housing lift. Remember, it was a housing crisis that took us into this thing. And there really was a housing lift from 09 to 14 or 15 during that recovery. And there has been absolutely no lift to housing since the recovery moved to expansion. So then you can see this in this chart. We're flatlining 30-year mortgage rates. We've been down here 2-3 times before in the last 5 years. And effectively, because housing prices have gone up and people have jobs, and they've already refinanced, this effect to the housing market is not likely to be here because we're in an expansionary phase which has different characteristics than recovery. So I'm not looking for anything out of the housing market. Next slide. Okay, this is a really fascinating one, which is uncertainty in the corporate bond market. Again, looking back at the earlier period, we have a long ways to go. And there was far more uncertainty in Christmas than there is now in the bond market. So not only are we not even back at Christmas levels, we're 400 basis points plus away from the 15 levels. So the high yield spreads are telling you definitely more uncertainty than 16 or 17, but that was low and probably too low. And now we're probably pricing in a level of uncertainty that's probably less than you think, and certainly less than I think. And so there's two answers here. Again, one is we're going to get a spiky rise out of it. The other is this is probably overstated in terms of the amount of effect it has on the economy. And that's where I'm at, which is it's probably overstated. And uncertainty is probably not going to go down to 16, 17 levels, but given the amount of sedation coming out of the European Union, probable stimulus from Germany and China, don't be surprised if we actually keep at a fairly low level of sedated uncertainty in the triple B market. Next one. Okay, this is great stuff. Euro, US, this is the US dollar euro, by the way, not euro US dollar. So what you're seeing here is the US dollar got 10% stronger the last year and a half. So what that means is when we have 10% tariffs or 25% tariffs put on the US economy, it's a wash. It's a wash in dollar terms. The US dollar to euro could be US dollar to yen or US dollar to renminbi. They're all about the same here, which is the US has been sucking money in because we raised rates and the rest of the world didn't, and we've had a 10% stronger dollar. So the other effect here in the trade war that is that basically it hasn't mattered. It's just totally neutral for the pricing that's coming into the economy. It's not having an effect through the price channel that you would think. It's been, again, quid pro quo from the US dollar is taking the tariff rate and neutralizing it. And that's my basic point here is, again, not as threatening as you might think when you start looking at this stuff. Next one. All right, economic uncertainty. Again, we all hear this story, uncertainty is higher. It certainly is. How much higher? First, just look at this. I would think you would agree with me, we're certainly spiking more and higher since the Christmas period to now. And it's certainly higher than 16, although that period had real euphoric spikiness, and we don't see that now. So there's a little different tone to this uncertainty data, which is higher uncertainty and more durable uncertainty in the U.S. context. Let's go to the next slide. This was fascinating. I never heard of this chart, and I want to show it to you, which was equity market-related uncertainty, not macroeconomic uncertainty. So again, language matters here. I bolded it. Equity market-related uncertainty is the uncertainty that matters to all of us on this call, which is, what is the equity market going to do? And again, you can see equity market-related uncertainty from December on is very high and very durable. So that is a point we all need to understand is, in this market, we've had almost no return for 18 months, and we've had amazing amount of uncertainty. So month to month, quarter to quarter, the market's been way up or way down. But looking over it, it's just been uncertainty. And there has been nothing but more uncertainty. And frankly, looking at this chart, I think we should get used to the idea of more uncertainty for the equity market. Not as much uncertainty for the economy, but more uncertainty for the equity market, which is the basic statement I want to make. And language is important. More uncertainty for the equity market, not as much for the economy. Next one. Okay, so the bogey, the elephant in the room, obviously, is the U.S.-China trade war. I've explained to you that the dollar got stronger 10% in the midst of all this, so it basically neutralized the tariffs. I explained to you that the economic uncertainty is probably lower than you think, but the equity market uncertainty is probably higher than you think, and this all gets back to China. And here you can see unambiguously that economic uncertainty for China is way higher, by an order of 4 times higher than it was ever before. And this is the case in the United States. We know what it is. It's the trade war, and we know it's directed at China. And again, it's not likely to go down. It's spiking down off the highs, but that's only because it's retreating from such a high level. So here is the question. I'm going to go into my next slide. Go ahead and switch it over. And I'm going to ask you, okay, look, I'm going to take a different approach than you've had in the past. I've actually worked with Xi in Los Angeles, with the mayor of Los Angeles, and we actually met with the guy. So I have some credibility here. So what I'm going to do, I'm going to say to yourself, okay, if I were to end the trade war, how would I do it, right? And I'm going to do this to show you how tough it is that this is going to happen the next year. So here's my solution. If someone comes to me, I'm serious about what I'm saying here, and I really would do this. Okay, number one, there are 2 solutions to 2 different problems. I'm going to roll into one problem, but they're really 2 different problems. Number one, the FBI, quote, has 1,000 investigations into Chinese intellectual property theft, quoted July 24th, 2019. So they have 1,000 investigations into property theft, intellectual property theft. I 100% support that as having come back from China. Competition, copying and counterfeiting, the same idea over there. On a company level, this is a massive problem. So what would I do? I would set up a working group with the Chinese and use the FBI case detail. I would get into the granularity of these problems and identify multiple solutions, which would mean I wouldn't actually be macroeconomic about this. This would be a working group. I'd send the FBI over there and say, hey, look, this is what we got. So how do we deal with this? How do we fix one after the other after this? Probably 10 or 12 or 15 buckets. You can put all these things in and probably that many ways to get real achievements in place and protect everybody's intellectual property, not just the United States. Because the point here is if you got into this debate with the Chinese, they'd realize if they really are headed to an intellectual property world and a knowledge world, which they are, this issue concerns them as much as it does us. So that's my first point. This is its own problem. It has its own detail, and it has its own solution. Now let's go to the next slide. Okay, the second problem is the bilateral trade back with China. This is largely done because the United States overconsumes, and that's largely because of huge and growing U.S. federal deficits. We just saw today the deficit is going to be over $1 trillion by a year and a half from now. So that's a 5% deficit annually. That's probably twice what it should be. So the answer is fix it. If the deficit is causing the overconsumption, which causes the trade deficit, then there's no other solution than to lower the budget deficit. Now, obviously, this is tax raises and spending cuts, so it has to be bipartisan, and you can't do it very fast. You got to do 2 or 3 years' time. But my bottom line, I'll finish up on this slide. Quit blaming the Chinese for this. Own it. We do not need the Chinese for this discussion. It is not their problem, and they cannot solve it. It is our problem, and we can solve it. So my point is now I have a second way to do. I have a working group of the FBI for the intellectual property. I will have a bipartisan commission to balance the federal budget. 2 to 3 years from now, I probably have all this in a place that actually succeeds the American people. My third one that I didn't get in this slide is I'd get rid of the tariffs. I don't think they've done a bit of good. I think it's slowed global growth, and the easiest way to get myself elected is just to walk away from them and say it didn't work. I'm not going to play a role. My new idea is these 2 other solutions. So I would also walk away from the tariffing and just say, I'm done with that approach. It didn't work. Here's my new approach. I'm going down 2 directions. That's what I would do. So let's go to the next slide. All right, so how to end the trade war. In my opinion, as a result of what I showed you, this ends no sooner than the U.S. presidential election. The tariffs will not end until the president is gone. Respect for the FBI will not happen until the president is gone. A bipartisan budget committee won't happen until the president is gone. And ultimately, that is why recession risk is as high as it has risen. Because the bottom line is, the 3 things I need to get this done cannot happen before the election. Now, you can argue with me all the way you want them on that, but I'm doing this to get you to realize why we're on a recession. It's because people just simply do not believe this thing can be resolved before the presidential election. And I agree with that, and I hope I explained that to you today. Now let's go to my next slide. All right, this is the federal debt debacle. Again, left and right, throw the debt out there. The Chinese are going to not pay the debt. Japanese are paying the debt. We have too much debt. There's no stimulus, all this stuff. Look at these numbers. These are the last 30 years. Particularly look back to 2000, which is 361 billion payments, versus today, 497. Guys, over 18 years, we've grown the economy from 15 trillion to 22 trillion. The percentage of GDP has fallen from 2.6% to 2.4% because interest rates have fallen, because the Fed has basically refinanced all these debts. So again, the scare that we can't do a fiscal stimulus, the scare over the debt, all of this doesn't add up. We can actually stimulate, if we had to, out of a recession situation with the United States, and the interest expense is not onerous at this point in time. And by the way, most of the stuff's been rolled into 30, they're talking 50-year things, so it's locked down too. And so this is just an example where modern monetary theory don't agree with it, because it would, Stephanie Kelton leaves out the exchange rate effects, which cause them huge hyperinflation. She was right, but she is right about one thing. Wasn't that actually stupid during collapsing interest rates and low demand growth to actually have some of this happening? And so I don't make that argument, but you can see for yourself on this slide, we're not actually in a big situation, and maybe this was in some analysts probably wise. I mean, a language you might not otherwise hear from someone like me. Next one. All right, the yield curve. Again, it always happens in front of a recession. Well in front of a recession, not at a recession. Again, the language is important here. Yield curves inverse well in front of a recession, not at a recession. Here's an example. Date of inversion, December 1988. Date of recession, July 1990. That's 7 months. That's quick. If it happened now, what that means is we would have a recession by July or January, as early as January 2020. However, March 1998, date of inversion, date of recession, March 2001, 3 years later. That would mean we would have a recession in August of 2022, which is way out there, folks. It's way out there. December 2005 to December 2007. That's 2 years. So again, that means we're going to get a recession dated to August of 2021. The point is, these things are well in front of you. As a leading indicator that's 2 and 3 years in front of its event, basically worthless. We need to see credit struggles. We need to see job losses. And as I've shown you, we've seen none of that yet. And that's my point here. Yield curves on their own are not worth as much as yield curves with job losses, with credit spikes and big losses in the financial markets. That's more likely to get me at least on the side of a recession. Let's go to the next slide. Okay, I want to finish up before I go to Sheraz with just, these are two political scientists. These are Theodore, Vesta, and Radu, Cinpoes. They're not American. They are foreign. And their comments are here on Wikipedia. You can go to Wikipedia and find these. These are not my comments. But what I want to point out here is, if a regime is authoritarian, they actually end. Authoritarian regimes actually end. And so what you're going to find here, if you want an answer again that's kind of pessimistic about the outcome over the next year, they will tell you, Vesta will write that in general, authoritarian regimes, if we have one, will tighten control, it will not adapt. And that is the point I want to make here, which is, do not get optimistic on adaptation in the next year. Get more fixed on tighter control, which in this environment means more tariffs, more non-tariff events on both sides, and just a locking down of the approach into the election. That should be your base case. I do not think you can move it off the base case, but I also think it's highly uncertain that anybody can tell you what's going to happen the next year. And the other thing I want to point out is how authoritarian regimes end is, I underline it, legitimacy of the state is dependent on performance, which means not having a recession, stock market's doing well, people who bet on the government getting paid really well out of it. So what's going to happen, and we see this with the farmers right now, certain groups that don't see the performance pull the regime down from within. So that's the other thing we got to watch out for, is when this certain groups that believed in performance start to tug at this regime and say, hey, is it going to end? I'll finish up with totalitarianism and fascism. These are good names that people on the left throw into the regime that's currently in place, fairly or not. And I'm going to tell you it's not fair. Because what happens with totalitarian and fascism is you need basically an armed conflict, and you need military response and a military leader. So fascism is not in the table, and that language has gotten very radical, and it's not happening, and it's not likely to happen. It's very unlikely in the next year and a half that all we see is more control and more people getting upset that the performance hasn't been delivered. That is a much more modest case for what I think you should be prepared for than a lot of this language we're seeing out of people. It's just not going to happen. Now, it can happen after chaos, after a depression, after a military rises out of that. But that is a call that's multiple years away from us right now at a 3% unemployment rate. My point of this slide is just to point out that this is what political scientists tell you happens. And this is just to get your mind to a base case that says, this is what you should expect. It doesn't mean it's going to happen. It doesn't mean there's other ways that this can happen. In fact, it includes we can have a resolution of the trade war. It's all kinds of things that happen, but this is just what they tell you. And with that, I'll hand it over to Sheraz.
I'm going to jump in here, John, for 1 second. And again, I apologize for being late to the call. If recession cannot end until the election happens, any chance the markets are wrong this time in trusting the yield curve as a recession indicator?
Yeah, well, first of all, the markets are, pricing very effectively at fair value around 2,900 right now, Terry. I think the surprising thing about the stock market right now is how rational it's been and not how irrational it's been. And I think, just having gone through all this stuff about political systems and elections and all that stuff, at the end of the day, the market's cared about earnings, which we're going to go through, and that's what it's pricing. And so until we get some measure of earnings decline or growth, what we're in is a recession and a flatline earnings environment, and the market's going to just stagger around very, very chaotically, but it's staggering around about basically nowhere.
All right, Sheraz, let's take a look at that earnings picture. As we close the books on the Q2 reporting season, what does that growth picture look like for the quarter?
Thanks, Terry. Yes, I will show you a comparison of what we are seeing in Q2 earnings and revenue growth. But just before that, I want to give you a recap of what we saw. So including all of this morning's results, we now have 471 S&P 500 companies have reported. Retail is the only one that has some significant number of results still awaited, but for all practical purposes, the earnings season is moving towards the end point. For the companies that have reported, earnings are up 0.5%, revenues are up 4.7%, 75.6% are beating EPS estimates, and 57.3% are beating revenue estimates. If we look at Q2 as a whole, meaning combining the actual results we have seen from these 471 companies and then adding to that estimates for the still to come, Q2 is expected to be, earnings growth is expected to be 0.2%, so hardly any growth, essentially flat, and revenues are expected to be up 4.6%. So if we go to the next slide, here's the growth comparison, Terry, that you were asking about. So for the companies that have reported, you see that the Q2 growth is a shade better than what we saw in Q1, but is magnitudes below what we had been seeing in recent quarters. We have the 4-quarter average and the 12-quarter average, and a big reason for this deceleration in growth is primarily the very tough comparisons. Let's not forget that 2018, we got a huge one-time boost because of the corporate tax cut, which was practically extra dollars dropping down to the bottom. So if and we'll see a little later the full year picture too, but if growth is flatline relative to that unusually strong 2018 period, I count that as resilience and stability and not a sign of weakness. If we go to the next slide, in the next slide, here we are sharing how the proportion of companies beating EPS and revenue estimates in the June quarter compared to what we had seen from the same group of companies in earlier periods. The left-hand side chart is showing that for EPS estimates, the EPS beats percentage, and you can see 75.6% of these companies are beating EPS estimates, which is a little bit below the 77.1% in the March quarter, but way better than the December 18 quarter. If you go all the way to the right on that same left-hand side chart, you see the 12-quarter average is 75%, meaning the proportion of these companies beating EPS estimates is about in line with historical trend. And one interpretation of that is that getting into the June quarter, some people were saying perhaps estimates are too low or perhaps they had gone down too much. This suggests that is not the case, meaning that earnings estimates for Q2 were fair. The right-hand side chart shows the same comparison for revenue beats, and as you could see, revenue beats are notably below what we have been seeing in other recent periods. So that's the long and short of your question about the how the growth picture looks, Terry.
All right, let's take a look ahead now. This week, the retailers are reporting estimates for retailers in Q3, especially specialty retailers, are getting cut. And you've noted in commentary other headwinds in that space also. So is that a source of worry for you going forward?
Yes, it is. And I have this slide where I'm sharing the current update on the Q2 earnings season for the retail sector. And as our audience knows, we have a standalone sector for retail, unlike those other folks who club retail into discretionary or other areas. So we have a fairly granular, clear, transparent view of what's happening in the group. So we have 28 of the 38 retailers in the S&P have reported results. This includes the Target and Lowe's that reported this morning. Earnings are up 3.9%. Revenues are up 8.5%. 64.3% are beating EPS estimates. 50% are beating revenue estimates. And we have a similar comparison here for the retail space as we had for the broader aggregate index earlier. And you could see that revenue growth is doing pretty good. This is the left-hand side chart. The orange bar is representing revenues. So there doesn't seem to be a revenue problem, but earnings is problematic. There's not much growth. On the right-hand side chart, we are showing the proportion of positive beats. And here, there's a problem on both fronts. Both EPS beats are tracking below historical trends, and revenue beats are also tracking below historical trends. And if we go to the next slide, this shows what Terry is referring to in terms of the estimate cuts. This morning's reports from Target and Lowe's were both very strong and both had positive commentary for the September quarter, but that has not been the norm for the space. And you could see here where I'm showing the earnings, total earnings for the retail sector, the year-over-year growth comparison from the end of June to today, and you could see that the growth trajectory has really come down since this quarter got underway. So Terry, yes, I agree. The estimates trend is negative, more so for retail than other sectors, and it has to be concerning for all of those who are interested in the space.
What about the tariff situation? Is that problematic for the high-end retailers, especially if the Chinese economy really goes south?
It is. John Blank in his presentation showed an interesting way how the exchange rates are adjusting to the tariff situation. He showed the exchange value of the U.S. dollar relative to the euro. If we looked at the exchange value of the Chinese currency relative to the basket of currency that they trade against, that has adjusted too. Though we all have questions about how freely that currency moves, but all of that has earnings implications. And retail, particularly the high-end retail that you're referring to, is dependent to a large extent on sales in mainland China. And we're not talking about trade here, we're talking about business in China, and as the outlook for the Chinese economy and also the periphery, let's not forget Hong Kong is going through some rough patch as well. That is problematic for a whole bunch of these high-end retailers. A big chunk of their growth is coming from China in particular, and then the broader Asia-Pacific markets in general.
All right, estimates for the S&P 500 as well as specific sectors affected by global growth have also been lowered for the second half of the year. Are these cuts going to be a driver, do you think, of U.S. economic uncertainty?
So it's yes and no, in fact. The reason I'm saying no is that the uncertainty is driving the earnings outlook, perhaps not the other way around. Some of the estimate cuts is normal. We experience estimate cuts for every period once we enter that period. You could view that cynically, you could view that and connect that to trends in the economic cycle. But what we are showing here on this slide is the revisions trend for Q3 estimates for the S&P 500 as a whole. And as you could see, the earnings growth for the period was expected to be negative in late June, and it has become even more negative today. I do want to caution, though, that even though this picture looks pretty grim and ugly from a market standpoint, this isn't totally out of line with historical trends, meaning the magnitude of cuts that we have seen here is about in line with what we have been seeing in the recent past, in any case. So nothing particularly unusual as a result of the big macro aggregate forces that John was discussing earlier.
So is there tariff impact on earnings for Q3 and Q4?
It is. There is an impact. Some of it is direct, and the next round of tariffs, which will have a bearing on a whole bunch of consumer-centric parts of the economy, will be more directly problematic for the Macy's and the Kohl's of the world. Though it appears that Target and Walmart and Home Depot seem to be doing just fine, but the indirect impact that the tariff has is more on the enterprise and business side, as John was showing earlier in his presentation, particularly that industrial production slide, which had flattened out earlier. That is a very clear demonstration of how the tariff uncertainty is weighing on business spending plans, and how those business spending plans and a weakness in that or a plateauing of that trend is having knock-on effects on corporate profitability. The saving grace has been the consumer. The consumer economy is doing very good. Consumer sentiment, even though it has come down a bit, still remains very healthy. That's looking back, though. Looking ahead, some people worry that this otherwise strong part of the U.S. economy may be at risk of weakening further. And if we see weakness on that front, that'll perhaps have a more direct earnings implication.
Okay, so put this big picture that we're seeing here in context for us.
So this is basically showing you the quarterly earnings and revenue growth for the S&P 500. The highlighted portion, the one in that rectangle, is the second half of the year. I shared the Q3 evolution earlier with you guys. Here we have added the last quarter of the year as well. And as you could see, the first 2 quarters of the year are essentially flat. Q3 is expected to be down 4.2%, and then Q4 is expected to be up 1.8%. So an essentially flat reading or a flat growth expectation for the year. And again, it's important to keep in mind before you take any major takeaways and lessons from this flat growth showing. This is not a bad showing, particularly when you see it in the context of where growth has been in the recent past. And as you could see in this chart as well, the 2018 growth was phenomenally strong, primarily driven by the corporate tax cut, and the fact that 2019 is shaping up to be a flat reading is no small achievement. And I think the earnings picture, the takeaway from something like what we are looking at here has to be positive and stable and not negative from the negative growth figures. So that's the big picture reading, Terry, by looking at the quarterly growth rates.
Okay, so just to underscore, 2019, when it's all said and done, bottom line, flat, not negative.
If it is negative, Terry, and we don't know how the picture evolves, as John mentioned earlier, and I'll steal his words. John said, "This is how I see the picture today." This is a quarterly call. If the picture changes in 3 months, then I'll say something different. Relative to expectations today, the reading is that 2019 should be flattish. If it's down, it's barely in negative territory.
Okay. But on a more positive note, you and I have also discussed that you do see a brighter earnings picture for the next year, correct?
That's correct. And let's see the next slide, which actually shows the growth picture on an annual basis. If we bring up the next slide, which is the annual growth rate, and that's the key. The key is that the market has essentially priced in a flat growth picture for 2019, but is looking ahead to a pretty strong showing in 2019. We seem to be having trouble bringing up the last slide. But even in this quarterly year-over-year growth rate, you could see that the first quarter of 2020 has 8.1% growth, and revenues are expected to be 7%. And this then continues and ramps up through the remainder of the year as well. And the expectation is for a 10+% growth in 2020. And even the following year, 2021, the expectation is for 8-9% growth. So yes, the market is looking ahead to much better growth in 2020 and beyond. And the behavior of stocks and all these major indexes will reflect how expectations for 2020 evolve in the coming days. Obviously, a lot of that is tied to how this tariff issue resolves itself, how these other macro questions get settled. But if we see a major revision to expectations for 2020, which we are not seeing currently, but if that happens, that I believe is the major risk factor.
Okay, well, we have to get through these next 2 quarters here first before we get to the optimism that you've outlined that's on the horizon. And with that, we have to wrap things up here for another call. It certainly was an information-packed call, and we hope that you found it informative with all the information that was shared by John Blank and Sheraz Mian. If you have any questions regarding our services, feel free to email them to zrs@zacks.com. And if you'd like copies of John's or Sheraz PowerPoint presentations featured in today's call, again, please email zrs@zacks.com. Contact your ZRS representative directly or access them in the presentations, that is, in the GoToWebinar console after the call. Meantime, thank you for joining us. Feedback is always welcome. In fact, after you close out this webinar, you'll be prompted to fill out maybe a 1-minute survey, and we would really appreciate that you do fill it out. We use those comments to try to improve the quality and content for future calls. And, as always, we'll look forward to the next time we're all together on the call.